Hello, everyone. It's great to be here. Thank you so much for coming to the Digital Evolution Institute conference. I will introduce a couple of very interesting topics to you today. It's all about how technology is disrupting both the markets, how we invest, and also what's going on in on the sustainable development end and how tech can help us there. So this is very much aligned to the overall topic of digital evolution. Excellent. All right, so many of you are in the investment world, and it's not going to be news to you that the market structure fundamentally has been changing. Over the past quarter century, there's been a decline in the number of publicly traded companies, and buyout and venture capital firms have really stepped in terms of allocating investments. So let me go over a couple of charts. So this shows you the decline in the number of publicly traded companies. This shows you the decline in IPOs. And this shows you the investor flows into US equity mutual funds and ETFs, as you can see, dropping off the cliff, right? So this is the money pouring into the public markets. And this is how well the venture capital has done. So you see almost an exponential growth line right there. So this is where the money has been pouring in. Now, over the past decade alone, the AUM that went into the private markets has tripled. And it's predicted to surpass 18.3 trillion by 2027. And all of this is according to Bloomberg. So what is happening? Let's talk a little bit about the drivers of change. Why are we now getting into the private markets at this speed? So first of all, expected returns. Secondly, the nature of investors has been changing. Legislative change, right? Legislation has been largely positive and fueling this change. And the impact of tech, something that we really love here. Okay, private versus public performance. Listen, by any measure, broadly, if you are in private markets, you're going to do better than you're going to do in public markets overall. So the Yale endowment model has been winning big time. This is S&P versus angel investments. I mean, look, we can argue about how all of these charts are constructed and what's included and what's not included, but if you look at studies that have been done over time, and we posted, by the way, we posted all of the backups for this on the Digital Evolution.Institute website, so you can actually check all of it. By and large, the story is very, very similar. Risk and reward for various asset classes. You can see venture capital up there, right above mid-cap equities and large equities. So your risk-adjusted returns are better for private markets. And investors obviously are not blind to that. All right, a shift in the nature of investors. Here's the shift in US equity investors from individuals to institutions. You can see individuals declining, right? And institutions have been pouring more money into the market. So what happens is now there is more need for the professional management, right? They want to deal with your venture, with the GPs and venture partners. US pensions and endowments move to alts, big time. Institutions allocating to alternatives. I show you a little bit, more than just the pension funds, because this covers foundations and sovereign wealth funds. It's the same story, kind of, Legislation, so back in the day when we talked about the prudent investor, it actually was interpreted as invest in liquid stuff. And then investors thought about it a little bit more, and regulators basically said, hey, it is prudent to diversify. So why didn't you diversify? And people started actually doing that. So that was a big boost. Tech. Paul Romer, an economist who won the Nobel Prize in economics for his work on endogenous growth theory, What is that? He basically posed a very important question. How is it that we're wealthier today than we were 100 years ago? Because our resources have not increased. So what are we doing? We're basically doing more with the same resources we had. Tech is a big part of it, right? We're able to innovate and do more with the existing, number of people and resources. So, speaking of investors, you know that investment activity overall is not a super efficient project. It's not a super efficient process, rather. So, for any one investment that's made, on average, we look at 80 opportunities. We have 20 meetings. We have 4 negotiations. You need 3, by the time you get to due diligence, and that is going to end up in one investment. Super labor intensive and time consuming, right? But there's tech that's going to actually make it much more efficient. And some of this technology, I don't unfortunately have a lot of time to go into each one of them, but there are now alternative marketplaces that automate a lot of this stuff, right? Because you can say, I'm looking specifically for XYZ, and you can search, and AI is actually going to match it to the investments that you want. This is actually going to have a huge impact on the markets, because if we tokenize some of the private investments, basically we're going to be looking at mutual funds and ETFs that are going to have tokens of private investments. All right, so now let's switch a little bit into the sustainable development topic. Let's talk about the goals and let's talk about the risks. So the goals, the aspirational aspect of this is obviously the 17 UN Sustainable Development Goals. We can argue about how well they've been defined. We know that they're aspirational, but let's look at the risks. So this is coming from the World Economic Forum. So this is the leaders in the industry basically saying what is it that they're mostly concerned about over the next 2 years and over the next 10 years, okay? Very interesting. Let me show you how all of these topics are arranged in terms of technology and environmental risks. As you can see, in the next 10 years, the majority of what's top of mind is going to be in the environmental and tech sectors. So how are we going to do on that? Well, we know that large corporations mostly set to fail any of the climate goals that they have. I mean, what you saw previously in terms of sustainable goals, fintech is going to address some of them. Climate tech is going to address some of them, right? So it goes across the board, but some of the climate tech goals are mandated. They're not fintech, it's great if you're very efficient, but if you're not, no one's going to come after you. Now, these goals are there's going to be consequences for not meeting this. And what we see based on that is the demand for climate tech, for fintech, for AI to close all of these gaps is going to accelerate. Because let's think back to Romer, right? We're not going to have significantly, more people working on solving these issues. We're not going to have more resources, but tech is going to have to close the gap. Mercer, who advises, the company that advises on $400 billion in AUM, spoke at our conference in New York last week, and they surveyed asset owners who basically said 50% plan to increase allocation to sustainability, essentially. I wanted to give a little plug to LA and San Francisco, who are world's largest climate tech hubs, by the way, which is awesome. So where does this lead us? And here's the hypothesis that I wanted to outline and invite all of you to contribute to a conversation on this. Where we see this going is that private markets are coming full force into becoming huge players, more so than the public markets, right? Why? Because of higher expected returns, because of diversification, inflation hedge, because of financial product innovation that we looked at, all of these alternative marketplaces and the ability to tokenize and access to institutional quality managers. Now, the innovation pipeline that is powered by tech and some of the huge innovation players in fintech and climate tech and AI, emerging technologies, cybersecurity, right? There's like a pipeline of innovation meeting that. All of that is going to be delivered efficiently via alternative marketplaces. And this is where we see an enormous source of growth that's going to propel us over the next 10 years. And we invite you to have discussion on that within the Digital Evolution Institute. Thank you so much for your time.